I would say the underlying theme here is that we all know that tech has been the leader in the market for the last 18 months or so. But when we look at large cap software, for example, it's 35 to 40 times. It's hard for us to imagine that the next outperformer is coming from that group.
So things are getting expensive.
Just within certain sectors.
Yeah.
But there are still areas of the market where we see a lot of value, whether it's media or energy or some beaten down areas of tech. So we're really looking for the diamonds in the rough.
So in the media, you like Disney?
We like Disney, yes. You know, it's interesting because today we're talking about AT&T Time Warner, but I think the bidding war for Fox really underscores the idea that content has a lot of value. And I think Disney, they have a long track record of creating value from their content. Right now, the industry is in transition because everyone is trying to shift their content from being consumed in the traditional bundle to being consumed over the top. And Disney is actually taking big steps towards that goal. I think that's going to reinvigorate their growth down the road if you're patient.
At what price is Fox too expensive, though, from your standpoint?
We're getting there. I mean, I think the original bid that they made, because there are so many costs that they can take out of the Fox business with the deal, it was still accretive. Now we're talking more longer-term accretion, so maybe dilutive in year one and accretive thereafter. But I think what the Fox assets do for Disney is they are moving their content over the top, and to the extent that they have Fox's content as well as theirs, I think it increases their chances for success. There are very few players that can put all their content over the top and have enough so that you'll subscribe.
Your top holdings are recognizable names: Amazon, Microsoft, Visa, Adobe, Facebook.
Yeah.
How do you go forward and outperform everybody else, even holding those big names?
Well, those names are so big in the index, it's a little bit misleading. I mean, tech is 40% of the Russell 1000 Growth Index. And so, of course, we own those names. We're actually underweight technology right now, a couple hundred basis points underweight. And if you look at our tech holdings, it includes names like Oracle, which are not high flyers. It includes names like Qualcomm, which have not performed well. And so, you know, within our tech holdings, I think we're shifting a little bit more to some value, some defense.
Are Oracle and Qualcomm recent additions? I mean, they've been underperformers. Especially when you take a look at Oracle, for instance.
Qualcomm is a very recent addition, and Oracle, relatively recent addition, last 6 months.
So you are you're rotating into
We've been rotating into a little bit more value and a little bit more
Another
defense.
sector, you mentioned energy, an area you like.
Yeah.
Schlumberger is your favorite there. Why?
Well, Schlumberger it's a well-managed, very good quality company. Oil as a commodity is up 15%, and Schlumberger is flat year to date. So you know that there is some appreciation potential there. I would say that after several years of very little investment outside the U.S., now with higher oil prices, we're starting to see CapEx improve, and that's 60% of Schlumberger's business. So they're really levered to outside the U.S. increases in capital spending on exploration and production.
The trade war is taking up the lion's share of our headlines.
Yeah.
How does that influence where you want to put your money?
You know, it's something we've been thinking about, although right now I think the trade war is really a manageable risk. I mean, our just back of the envelope numbers imply that the trade war as it's being contemplated right now, so the tariffs that have been announced and implemented, that's about a $50 billion headwind to the U.S. economy. That's not nothing, but we're also sitting in the face of a $200 billion stimulus from tax cuts. So, and we have 3% GDP growth. So those are kind of manageable costs as we see them now. I think the real question and the risk that might make us make changes in the portfolio is what happens in rounds 3, 4, and 5 of this trade war escalation. How bad does it get? Who else enters into the fray? What other goods are included?
But the qualitative retaliation that China could go down.
That's
I mean,
right.
They don't have that many goods to put tariffs on.
That's right. I mean, I think that gets back to technology, because I think one of the things that we think longer term is that, you know, China has been pretty clear about the fact that they want to build their own technology industry. To the extent that we have an escalating trade war, I think it only cements their view that that's the right move, and it may speed their efforts in that behalf. So that's a longer term competitive threat for tech.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.